Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Tuesday, July 22nd. The press release from Dow component American Express that details its second quarter performance is littered with plenty of worrisome points. We will explore some of those points in a moment. First, though, we want to call listeners' attention to how the press release ends. The final line of the prepared text is a simple yet very important one to consider in the midst of Tuesday's sell-off. It reads as follows, quote, American Express is a leading global payments and travel company founded in 1850, end quote. With over 150 years of operating history, it is safe to say American Express has seen its fair share of business cycles. At the moment, it is clearly engrossed in a down cycle, and not surprisingly, its stock price has followed suit. Entering Tuesday's trading, shares of AXP were down 21% year-to-date and down 38% from the 52-week high they hit last July. Those declines have been extended in the wake of the company reporting a 37% decline in second quarter income from continuing operations to $655 million, or 56 cents per diluted share. The latter was 27 cents below the consensus estimate. Led by its international card services and global network and merchant services segments, revenue net of interest expense actually increased 8% versus the year-ago period. Expenses were up only 6% for the period, but the leverage disappeared quickly with the inclusion of a $600 million addition to U.S. lending reserves. In addition, American Express incurred a $136 million charge to fair market value of its retained interest in securitized card member loans. American Express noted its coverage levels are now substantially higher than at any point during the last 3 years, and that its current level of reserves reflects an expectation that write-offs will continue to rise in the remainder of 2008. The latter view followed on the heels of an acknowledgment that fallout from a weaker U.S. economy accelerated during June. Management went on to say that consumer spending slowed during the latter part of the quarter and that credit indicators deteriorated beyond the company's expectations. Strikingly, American Express observed that the economic fallout was evident even among its longer-term super prime card members. That was a startling observation for the market, as was the declaration by the company that it is no longer tracking to meet its prior forecast of 4% to 6% earnings per share growth. American Express further clarified that it doesn't expect to meet or exceed its long-term financial targets until it sees improvements in the economy. In all, the report from American Express was a candid exposition of the challenges with which it is now confronted. Those challenges, incidentally, are not company-specific. The bad news is that it doesn't sound as if American Express is envisioning a quick solution. However, when affluent customers get caught up in the downturn, it is typically a sign that we are closer to the end of a down cycle than the beginning. Then again, when the recent All-Star game hit the ninth inning, it too was closer to the end of the game than the beginning, only that game ended up going 15 innings. Might we be in a similar situation here? Perhaps. The good news is that this too shall pass for American Express, just like every other down cycle seen in the last 157 years. When it does, the fortunes of the company and its stock will be much improved. In the meantime, this is a stock investors should keep on the radar screen as a long-term investment idea. Although earnings per share growth may prove elusive this year, the stock, at 12 times trailing 12-month earnings, trades at a 40% discount to its 10-year historical average. Our belief is that investors willing to accept the possibility of further downside over the near term will look back at this period and realize there was long-term value to be had in the stock at current prices. I'm Pat O'Hare for Briefing.com. Thanks for listening.